Hi, and welcome to our end of September update from the Wealthy Doctor Institute, physicians leading physicians through finance. We work with physicians and other busy professionals who are not happy with their current investment strategy. We help them get this part of their lives handled so they feel empowered and in control. I'm David Ye, and in my book, The Busy Doctor's Investment Guide, I show you just a few ways where just a few adjustments each year can help build and protect wealth. Although the strategies in this book are easy to calculate each month, for those of you who are new to the concepts of my book, or for those who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So in this month, we'll review our systems, starting with the safety belt systems, then reviewing how momentum rotation systems can dovetail with our safety belt system, and then we'll monitor the free sector surfer strategy that comes with any sector surfer subscription. Then we'll remind ourselves of the rules for the stock tip strategy. So let's get started. So when we review our systems, we'll start with the first, what I call safety belt systems for the stock market. So the one I described in my book is called the 20-month simple moving average system. All it is a way to help figure out whether or not it's relatively safe or dangerous to be in stock market in any one month. Note that no system can guarantee against any losses. However, if we try to look out for the larger losses early enough to make a difference, this will help increase our chances of survival during the market crash. So the 20-month moving average rule, it's simple. All you do is take the S&P 500 Index Mutual Fund, take the average price of the last 20 months, and if the price of the index fund is above the moving average, it's relatively safe to be in the markets. Otherwise, get out. Now remember, this rule only works if you watch once a month. Not more often, not less often. Don't skip months. So here's a graphical representation of what I've been talking about. This blue line, this blue jagged line, is the price history of the Vanguard S&P 500 Index Mutual Fund. The reason why I use Vanguard is because they've been around longest, so I have much more data to plot out for this example. And then this red line is smoother because this is an average of the last 20-month prices. And if we take a look at this month, September ended with a price of $274.71 per share, and the moving average went up to $256.97. So you can see the blue line is still above the red line, so it's still relatively safe to be in the markets according to this system. So I just like to do this one additional step. You don't have to, but if you take a look at the price of the fund divided by the price of the moving average, and we have a 6.9% cushion. In other words, next month, as long as the stock price keeps going up, stays the same, or even goes down as much as, but not more than 6.9%, we're still relatively safe against major multi-month and multi-year bear markets. So here's Sector Surfer's version of the seatbelt filter. We're using the same stock market index fund versus the same bond fund using their version called Storm Guard Armor. If we use Storm Guard Armor, we can see that, yes, at the end of August, we got this signal to get out of stocks and go into bonds. Of course, this was when stocks kind of went up, but bonds started to go down. Therefore, if you've been following this, you know that September 19, we had this signal to switch back into stocks. So of course, we're back in stocks, and stocks started to drift down again, just like how it's paralleling the stock line up here, only now we're down here. So just to show you that no system is perfect. We're lagging the stock market this year with this system. We don't beat the markets every year. We don't match the markets every year. Sometimes we beat it, sometimes the market beats us. What we're trying to do is trying to avoid the big bear markets, which are what is more dangerous in the long run. So here is the graph of the Storm Guard indicator. You can tell how for the beginning portion of September we were actually negative, so that's why we were in bonds, and of course it went back up to positive 0.02%. which is technically safety territory that we go back into stocks. We have to draw the line somewhere, and we draw it at a zero line. So technically, the trade alert was back mid-September, but it is a trade alert. If you missed it, it's rare that we get a mid-month trade alert, and this year we've gotten two. And the reason why we get these is that sometimes the markets go sideways, but volatile. In other words, up and down on a monthly cycle. If it goes up and down more slowly, this system does not get whipsawed nearly as much. If it goes more quickly, then for all intents and purposes, there is still a detectable trend. So our next system is adding momentum rotation systems to our safety belt system. Now, in my book, I described a system I call the monthly rotation investment system, or the MRI system for short. And for those who have read the book, you know the system, and for those of you who have been following this video, you know I no longer follow the MRI system as I described it in my book. In fact, we can do a sector-servant version of the MRI system using the same three funds, the S&P 5 Index Fund, the Emerging Markets Fund, and the Inverse S&P 5 Index Fund. And now I don't even follow that system anymore because strong guard armor is more effective, at least statistically in the past, of protecting us from larger losses in bear markets. So here's an example of rotation. If we take a mix of mutual funds, here represented by several different funds, from real estate to treasury bonds to large cap, mid cap, small cap stock funds, international emerging market stock funds, we can see that all the various components as plotted are as follows. However, the yellow line is when we check once a month to see which one of these funds has the best momentum after stripping away the noise and buying that one fund. And with this system, we're trading maybe 4 times per year on average, and we get this yellow line, which you can see we don't lose much during the crash of 2000, 2002, and 2007, 2009. However, if we add in the safety belt system, we get this graph where we take away the bond fund from the system and make this the dangerous for stock go-to fund using strong guard armor. Just by rotating through these remaining 5 stock funds and going to the long-term treasury bond fund during the dangerous for stock phases, we smooth out this yellow curve and we only trade maybe 2 times per year on average, increasing our overall return, at least in the past. And yes, there was a trade alert in mid-September with this system as well. Now, Sector Server does come with a free strategy. When you sign up, you do not have to build your own system from scratch, nor do you have to subscribe to one of the pre-built systems and pay a monthly fee. You can use one of the free strategies. Now, the drawback of using free strategies is that they do use generic asset class funds. They use an older version of StormGuard, and they do not separate out stock from non-stock funds for rotation purposes. But if at least looking at the historical backtesting data it's good enough for you, then it's possible to use Sector Surfer for free. So here's an example of one of the free strategies called My ETF Asset Class. It uses many of these ETFs representing many broad market sectors as well as international sector funds and get this yellow line. If this system is good enough for you, then you may want to consider using something like this. And with this particular free Sector Surfer strategy, we did not get triggered with any trades this past month. So the next system is a stock tip strategy. Just to remind ourselves of the stock tip strategy rules, this is only if you, for some strange reason, absolutely positively need to buy this one particular stock for some strange reason. I do not suggest it. However, if you do want to do that, limit your risk to any one stock to 1% of your portfolio or trading account. And the way you do this with this system is if you have a 25% trailing stop loss order, you can use 4% of your trading account to buy that one stock. You see how if you use 4% of your trading account buy that one stock and goes down 25%, you've only lost 1% of your total portfolio, even though the stock itself lost 25%. Remember, people buy stocks because they fall in love with whatever story is behind that stock. They think the stock's going to go to the moon, never realizing that, yes, stocks go up and stocks go down. And in the stock market, there's no such thing as a sure thing. So if the stock goes up 33%, you can go ahead and buy another block of stock using another 4% of your account and update your trailing stop loss order reflecting the increased number of shares. Keep on doing until you're eventually stopped out, because make no mistake, you will be stopped out eventually. So in summary, this month we've reviewed our systems, including our safety belt systems, adding our momentum rotation systems, including analyzing generic sample strategy using only momentum rotation systems and see how that can be dovetailed with the safety belt system. We've looked at our free sector survey strategy that we've been tracking every month with these videos, and we went over the stock tip strategy. Okay, keep those questions coming. I know I talked to several of you personally each month, and I realize that for some of you, these videos updates are not enough, especially if you're still unhappy with the current investment strategy or lack of strategy. I'm going to offer a complimentary investment wellness checkup session for you, just you and me. Ask all the questions you want, no matter how seemingly basic or clueless you think you are. In our checkup session, we'll together create a sense of clarity about the financial future you really want, the reasons you're investing to begin with, and how to get you there, discuss investing building blocks that are more specific to your situation, determine what has stopped you in the past from getting what you want, and identify what are the most important steps you need to take now to get your investing and financial goals, and then complete our consultation with the excitement of knowing exactly what to do next to create that road to the future you really want. Think CME, only the topic is financial and tailored to you. Think wellness checkup, because whether or not you feel financially well, if you had a financial cancer or blind spot you didn't know about, wouldn't you rather at least know so you can deal with it before the problem grows and metastasizes? Don't be bashful reaching out. The more you delay, the more time is against you. So, until next month, invest safely.